The Treasury Department just flagged an $800 million wire transfer that has triggered the most extensive financial compliance review in a decade. At 9:42 a.m. Eastern Time on February 22nd, the Financial Crimes Enforcement Network issued an emergency alert to federal law enforcement after suspicious activity reports revealed a massive international fund transfer with characteristics that analysts say indicate potential money laundering, sanctions evasion, or both. And this wasn't routine transaction monitoring or standard compliance protocols. This was Treasury's Office of Foreign Assets Control activating emergency review procedures reserved for transactions that pose national security threats or involve violation of federal financial crimes statutes. When Treasury flags an $800 million transfer and launches immediate compliance review involving multiple federal agencies, you're watching financial investigators respond to evidence of potential crimes so serious that normal banking channels were hijacked for purposes that violate federal law. Hit that subscribe button right now, because what I'm about to reveal will fundamentally change your understanding of how massive, illicit financial operations get exposed. So what triggered this unprecedented Treasury compliance review? According to 7 sources with direct knowledge of the suspicious activity reports, financial institutions filed mandatory alerts on February 20th after detecting an $800 million wire transfer that moved through 3 correspondent banks across 2 continents with beneficial ownership structures designed to obscure the ultimate recipients of the funds. The transaction originated from accounts controlled by entities in the United Arab Emirates, transited through banks in Cyprus and Switzerland, and ultimately reached accounts in the United States linked to shell companies with no legitimate business operations. This wasn't a standard international business transaction with complex routing for tax or regulatory reasons. According to Treasury analysts who reviewed the suspicious activity reports, the transaction displayed every characteristic that financial crimes investigators associate with deliberate attempts to launder illicit proceeds or evade sanctions through layered transfers designed to break the audit trail. The compliance review mechanics tell you everything about how seriously Treasury is treating this transaction. Within hours of receiving the suspicious activity reports, FinCEN analysts traced the beneficial ownership through multiple corporate layers and identified connections to individuals and entities on federal watch lists, including suspected sanctions violators and persons of interest in ongoing criminal investigations. Treasury immediately froze the funds in U.S. accounts pending completion of the compliance review and issued administrative subpoenas to every financial institution that handled any portion of the transfer, demanding complete documentation of account holders, transaction authorization, and due diligence performed before processing the transfers. One banking compliance officer who received Treasury's subpoena told reporters the document demanded more granular information than anything they had seen in 15 years of handling federal financial investigations. When Treasury issues administrative subpoenas of that scope and freezes $800 million pending review, you're looking at investigators who have already identified serious red flags and are building a case that could result in criminal charges, civil penalties exceeding the transaction amount, or both. Smash that like button if this is making sense so far. Here's where it really gets serious. The timeline reveals how rapidly this investigation escalated once Treasury analysts connected multiple data streams that individually seemed unremarkable but collectively indicated sophisticated financial crimes. On February 15th, a routine compliance algorithm at a major New York bank flagged an incoming wire transfer for $287 million from a Cypriot correspondent bank as requiring enhanced due diligence based on the amount, origin, and beneficial owner opacity. The compliance team conducted standard review over 4 days, attempting to verify the commercial purpose and ultimate beneficiaries of the transfer. By February 19th, the bank's investigators had determined they could not adequately verify legitimate business purposes for the transaction and filed a suspicious activity report with FinCEN as federal regulations require. That same day, 2 other U.S. financial institutions independently filed suspicious activity reports on related transfers totaling $513 million that appeared to be part of the same overall fund movement. FinCEN analysts reviewing the three separate suspicious activity reports on February 20th recognized that the transactions were linked through beneficial ownership structures and timing, indicating coordinated movement of $800 million through deliberately fragmented transfers designed to avoid triggering automatic alerts at any single institution. That's when Treasury escalated to emergency compliance review and froze all accessible funds. Drop a comment right now if you saw this coming. I read every single one. Now things get absolutely wild. According to documents filed under seal in federal court on February 21st, when Treasury sought judicial authorization to extend the fund freeze beyond the initial 30-day administrative period, the compliance review uncovered evidence that the $800 million transfer may be connected to efforts to circumvent sanctions on Russian oligarchs imposed after the invasion of Ukraine. The sealed court filing allegedly presents evidence that beneficial owners of the shell companies receiving funds in the United States have documented relationships with Russian nationals designated under sanctions programs, and that the complex routing through Middle Eastern and European banks was designed specifically to obscure those connections from automated sanctions screening systems that financial institutions use. Treasury investigators reportedly traced corporate ownership through 8 layers of shell companies across 6 jurisdictions before identifying Russian nationals as ultimate beneficiaries of accounts receiving portions of the $800 million. One former Treasury official who reviewed the sealed filing told reporters that the evidence suggests a level of sophistication in sanctions evasion that indicates professional financial operatives with detailed knowledge of how international banking compliance systems work and how to design transactions that evade detection. This isn't the first time Treasury has confronted large-scale sanctions evasion or money laundering through the international financial system, but the specific characteristics of this case represent escalation in sophistication and scale. Consider the 2012 HSBC money laundering scandal when the bank paid $1.9 billion to settle charges of laundering proceeds for Mexican drug cartels and processing transactions for sanctioned entities, including Iranian banks. That case involved systematic compliance failures where the bank deliberately maintained inadequate controls that allowed illicit transactions to flow through their systems for years. Treasury and the Justice Department imposed massive penalties and required comprehensive remediation of compliance programs. Then there was the 2018 case involving Deutsche Bank, which paid $630 million to settle charges related to a $10 billion Russian mirror trading scheme that allowed Russian oligarchs to move money out of Russia in violation of sanctions. That scheme involved coordinated trades in Moscow and London offices that converted rubles to dollars through securities transactions designed to appear legitimate while actually serving as vehicles for sanctions evasion and money laundering. Subscribe immediately if you haven't yet. This content doesn't exist anywhere else. And consider the ongoing investigations into cryptocurrency platforms that have been used to evade sanctions, including the 2022 case where the Treasury designated virtual currency mixer Tornado Cash for laundering more than $7 billion of cryptocurrency, including hundreds of millions linked to North Korean state-sponsored hackers. That case demonstrated how technological innovation creates new money laundering vulnerabilities that sanctions evaders and criminals exploit faster than regulators can develop effective countermeasures. The pattern across these landmark cases is that sanctions evaders and money launderers constantly adapt to compliance systems, developing increasingly sophisticated techniques for moving illicit funds through legitimate financial channels while avoiding detection. Now, Treasury has identified an $800 million transfer using shell companies, multiple correspondent banks, and deliberately opaque beneficial ownership structures in what investigators believe represents sanctions evasion connected to Russian oligarchs. That combination of scale, sophistication, and geopolitical significance makes this potentially the most serious sanctions violation case since the Ukraine invasion triggered comprehensive sanctions programs. So what makes this Treasury compliance review so significant beyond the immediate investigation into one large transaction? According to financial crimes experts who have analyzed similar cases, this review demonstrates several critical aspects of how federal authorities detect and respond to major sanctions violations and money laundering schemes. First, It shows that Treasury's Financial Crimes Enforcement Network has developed sophisticated analytical capabilities that can identify coordinated transactions across multiple institutions by recognizing patterns in beneficial ownership, timing, and routing that indicate deliberate fragmentation designed to avoid detection. The ability to connect 3 separate suspicious activity reports from different banks and recognize them as parts of a single scheme represents significant analytical advancement in financial intelligence. Second, it signals that Treasury will aggressively pursue sanctions enforcement, including freezing massive sums and deploying comprehensive investigative resources when evidence indicates deliberate evasion efforts supporting sanctioned individuals or entities. The immediate fund freeze and emergency compliance review demonstrate that financial sanctions remain a priority enforcement area, with consequences extending beyond civil penalties to potential criminal prosecution. Third, it establishes that even highly sophisticated sanctions evasion schemes using multiple jurisdictions, layered corporate structures, and fragmented transfers remain detectable when financial institutions file required suspicious activity reports and Treasury analysts apply pattern recognition to identify coordinated illicit activity. Don't go anywhere. The most explosive part is coming next. And here's what should concern everyone who follows international sanctions enforcement and financial crimes prosecution. Multiple sources report that the Treasury Compliance Review has expanded to examine whether U.S. persons or entities facilitated the sanctioned individual access to the American financial system in violation of federal law prohibiting material support for sanctions evasion. The investigation allegedly includes subpoenas to law firms, accountants, and corporate service providers who established the shell companies that receive funds, demanding documentation of who hired them, what due diligence they performed on beneficial owners, and whether they had knowledge or reason to know that the corporate structures were being used for sanctions evasion. Federal prosecutors treating professional facilitators as potential co-conspirators in sanctions violations represents significant escalation because it extends criminal liability beyond the individuals directly evading sanctions to encompass the lawyers, accountants, and corporate formation specialists who create the structures that make sanctions evasion possible. One former federal prosecutor who handled major money laundering cases told reporters that if Treasury and Justice Department can prove that professional service providers knowingly or recklessly facilitated sanctions evasion by establishing shell companies without adequate due diligence on beneficial owners, those providers face criminal charges under conspiracy and aiding and abetting statutes. Here's the legal complexity that makes this compliance review so consequential for the financial services industry and international banking operations. There's fundamental tension between the legitimate need for corporate privacy and banking confidentiality in international commerce and the law enforcement imperative to penetrate beneficial ownership opacity that facilitates sanctions evasion and money laundering. Financial crimes experts are calling this the central challenge that Treasury's investigation must navigate. A former FinCEN director told news outlets that international business frequently uses complex corporate structures and multi-jurisdictional banking for legitimate tax planning, regulatory compliance, and commercial confidentiality purposes, making it difficult to distinguish legitimate transactions from illicit schemes based on structural characteristics alone. Banks and compliance professionals must balance customer service and competitive pressures against regulatory requirements to verify beneficial ownership and transaction purposes, creating environments where sophisticated evaders can exploit gaps. A current Treasury official added that sanctions evaders deliberately design transactions to mimic legitimate commerce, using actual businesses and real commercial documentation to create plausible cover for what are ultimately illicit fund transfers serving sanctioned parties. The $800 million transfer investigation will likely turn on whether Treasury can prove that the transaction lacked legitimate commercial purpose and that beneficial owners were sanctioned individuals despite the elaborate corporate structures designed to obscure those connections. Do me a favor and slam that like button because it genuinely helps this video reach more people. Even financial services industry representatives who advocate for balanced sanctions enforcement that doesn't unduly burden legitimate commerce acknowledge this case presents serious red flags requiring aggressive investigation. One banking industry association spokesperson told reporters that while banks work diligently to comply with sanctions regulations and file suspicious activity reports as required, the characteristics of this $800 million transfer, including massive amount, complex routing, opaque beneficial ownership, and fragmented structure across multiple institutions, represent exactly the type of transaction that warrants comprehensive Treasury review and potential enforcement action if violations are confirmed. So let's break down what this compliance review means for immediate enforcement actions and the broader implications for sanctions effectiveness and financial crimes prosecution. First, the economic impact on the individuals and entities whose funds are frozen is immediate and severe. The $800 million is inaccessible pending completion of Treasury's review, which could take months or years if the investigation leads to criminal prosecution. If Treasury ultimately determines that the funds represent proceeds of sanctions violations or money laundering, the government can pursue civil forfeiture of the entire amount plus civil penalties that can reach twice the transaction value under applicable statutes. Before this freeze, the beneficial owners had access to $800 million in the U.S. financial system for investment, transactions, or further transfer. Now, those funds are locked pending government investigation and potential permanent seizure if violations are proven. Second, it fundamentally changes the risk calculus for professional service providers who facilitate complex international transactions and corporate structures. Lawyers, accountants, and corporate formation specialists now face potential criminal liability for establishing entities and structures used for sanctions evasion if Treasury can prove they had knowledge or reason to know of illicit purposes. This creates enormous pressure for enhanced due diligence on beneficial ownership, even for legitimate clients who may have privacy concerns about disclosing ultimate owners. A former Big Four accounting firm partner described this as transforming the professional services industry approach to international client relationships because the risk of becoming entangled in federal sanctions investigations now outweighs the revenue from clients who cannot or will not provide transparent beneficial ownership information. Drop a comment below with your thoughts. I'm genuinely curious to see your perspective. But beyond the immediate investigation and enforcement implications, this Treasury compliance review is fundamentally about whether comprehensive sanctions programs can remain effective when determined evaders deploy sophisticated schemes using multiple jurisdictions, professional facilitators, and legitimate business structures to move massive sums through international banking systems. Sanctions only work if evaders cannot access frozen assets or operate in sanctioned economies. If oligarchs and other sanctioned parties can consistently circumvent financial restrictions through layered shell companies and complicit professional service providers, sanctions become symbolic political statements rather than effective economic tools. What we're watching is Treasury testing whether enhanced analytical capabilities, aggressive enforcement including criminal prosecution of facilitators, and massive penalties can deter sanctions evasion, or whether the international financial system remains too complex and fragmented to prevent determined sophisticated actors from moving money despite sanctions. The $800 million frozen in this case represents Treasury demonstrating capability and willingness to detect and stop even highly sophisticated evasion schemes. But whether this investigation results in successful prosecution and deterrent effect remains to be determined. This scenario is causing genuine concern in international banking circles about the compliance burdens and legal risks associated with correspondent banking relationships and complex international transactions. Sources report that when news of the $800 million freeze reached major financial institutions, compliance departments immediately initiated reviews of their own international transaction monitoring to ensure they aren't processing similar transfers that could trigger Treasury enforcement action. Multiple banks have reportedly begun restricting or terminating correspondent relationships with institutions in jurisdictions known for weak beneficial ownership transparency, deciding that the regulatory risk outweighs the business opportunity. One major bank compliance chief told reporters that the regulatory environment has shifted from viewing suspicious transaction detection as best practice risk management to treating it as critical legal compliance, where failures could result in catastrophic penalties and potential criminal charges against institutions and individuals. Meanwhile, sanctions compliance consultants are advising clients that any international transaction above $10 million with opaque beneficial ownership should be presumptively declined unless complete transparency can be achieved, because the risks of inadvertently processing sanctioned party transactions have become existential for financial institutions and professional service providers. Meanwhile, Treasury officials and sanctions policy experts are emphasizing that robust enforcement, including aggressive compliance reviews and substantial penalties, serve critical national security and foreign policy objectives. A bipartisan group of former Treasury and State Department officials issued a statement explaining that financial sanctions represent America's most powerful non-military foreign policy tool, and that sanctions only remain credible and effective if violators face serious consequences, including frozen assets, massive penalties, and potential criminal prosecution. They emphasized that oligarchs and other sanctions targets will constantly probe for weaknesses in enforcement, and that Treasury must demonstrate through cases like this $800 million investigation that sophisticated evasion schemes will be detected, prosecuted, and punished. The statement urged Americans to understand sanctions enforcement not as bureaucratic compliance exercises, but as essential national security operations that constrain adversary nations and malign actors through economic pressure when military options are unavailable or undesirable. But those policy arguments are being complicated by concerns from international commerce advocates who warn that overly aggressive sanctions enforcement risks isolating the United States from international financial systems if foreign banks conclude that maintaining U.S. correspondent relationships creates unacceptable regulatory risk. Stay with me. What comes next will completely change how you view the situation. Here's what makes this Treasury compliance review even more consequential for understanding the evolution of financial crimes enforcement. The investigation doesn't rely solely on suspicious activity reports from banks, but also incorporates intelligence from NSA financial surveillance, international law enforcement partnerships through organizations like Interpol and Europol, and sophisticated data analytics that identify patterns across massive transaction databases that human analysts could never detect. Legal experts who study financial intelligence told reporters that Treasury's ability to connect the $800 million transfer to sanctioned Russian oligarchs through 8 layers of shell companies demonstrates how dramatically financial crimes investigation capabilities have advanced through technology and intelligence integration. The compliance review represents next-generation sanctions enforcement where governments can trace money through deliberately complex structures that previously provided effective opacity. This goes far beyond one $800 million transaction or even one sanctions evasion investigation. It's about whether nations can use financial sanctions as effective foreign policy tools when global banking systems are sufficiently complex that determined actors with professional assistance can evade restrictions through sophisticated schemes. If Treasury consistently demonstrates ability to detect, freeze, and prosecute even highly sophisticated sanctions evasion efforts, it establishes that financial sanctions remain viable policy instruments because evasion risks are too high for rational actors to accept. But if investigations like this $800 million review ultimately fail to result in successful prosecutions, or if oligarchs simply adapt with even more sophisticated schemes that Treasury cannot penetrate, it suggests that financial sanctions may be losing effectiveness as international banking complexity outpaces regulatory and law enforcement capabilities. What we're witnessing is the ongoing technological and legal arms race between sanctions enforcers developing better detection and prosecution capabilities and sanctions evaders developing more sophisticated techniques for moving money despite restrictions. The outcome of this specific investigation will influence whether future policymakers view financial sanctions as reliable tools or increasingly ineffective measures. If this blows your mind, hit that like button right now. Here's where we stand right now. Treasury has flagged an $800 million international wire transfer and launched comprehensive compliance review after suspicious activity reports revealed characteristics indicating potential sanctions evasion connected to Russian oligarchs. The funds have been frozen pending investigation completion, and Treasury has issued extensive subpoenas to financial institutions and professional service providers involved in establishing the corporate structures used. Federal prosecutors are examining whether criminal charges are appropriate for sanctions violations and potential conspiracy by facilitators who establish shell companies. And financial crimes experts acknowledge this represents one of the most sophisticated and largest sanctions evasion cases since comprehensive Russia sanctions were imposed. This is no longer theoretical discussion about whether sanctions can be effectively enforced against determined sophisticated actors. This is Treasury demonstrating advanced detection capabilities and willingness to pursue aggressive enforcement, including criminal prosecution, when evidence indicates sanctions violations. Keep a close eye on how this investigation unfolds, because the enforcement and policy implications will reverberate throughout international finance and sanctions policy. Treasury will continue analyzing the transaction trail and beneficial ownership structures to build a comprehensive case for potential civil or criminal enforcement actions. Financial institutions are reassessing their correspondent banking relationships and international transaction monitoring in response to this case, demonstrating the risks of processing transfers with opaque beneficial ownership. And policymakers are evaluating whether this investigation validates financial sanctions as effective policy tools, or whether it reveals that determined actors can still move massive sums despite restrictions when they deploy sufficient sophistication and professional assistance. Before we go any further, smash that subscribe button so you never miss content like this. Treasury has frozen $800 million connected to potential sanctions violations. The compliance review has expanded to examine facilitators, including lawyers and accountants who created corporate structures. Federal prosecutors are building potential criminal cases, and the investigation demonstrates how advanced financial intelligence capabilities have become in detecting sophisticated evasion schemes. This isn't just another financial enforcement case that compliance professionals will study while business continues normally. This is Treasury deploying maximum investigative and enforcement resources against what appears to be a sophisticated scheme to move $800 million in violation of sanctions programs serving critical foreign policy objectives. The frozen funds, extensive subpoenas, and expanded investigation of facilitators demonstrate that financial sanctions enforcement has become more aggressive and technologically sophisticated than ever before. Whether this compliance review ultimately results in successful criminal prosecutions, massive civil penalties, and permanent asset forfeiture that deters future sanctions evasion remains to be determined by the evidence Treasury can develop and prove. The stakes could not be higher for sanctions policy effectiveness. The enforcement implications could not be more significant for international banking compliance. And the Treasury Compliance Review just demonstrated that even $800 million transfers using multiple correspondent banks, layered shell companies, and sophisticated beneficial ownership structures remain detectable when financial institutions file required reports, and Treasury analysts apply advanced intelligence capabilities to identify coordinated illicit schemes.